Kadis.
Okay, let me start. It is the first presentation. It is on title on the effects of credit rating on credit default swap spread and credit spread. And this paper, or the author of this paper, is Professor Daniel Siu, and he is your friend, Jensen. It is the Journals of Fixed Income, and it's published on December 2005. Actually, the paper is, or the data dates for this paper is in the year between 2000 to 2002, but it's published on 2005, and the presenter will be just me and Girma. Then we group under two group. The first presentation will be made by me, and the second presentation will continue by Girma. Then let me start with introduction with this on the credits rating, on CDS and credit risk. Then introduction, credit start with the concepts of credit derivatives, and these credit derivatives are privately negotiated derivative instrument with the payoff of that are linked with credit sensitive asset or an index, and hints to the credit worthiness of a given reference entity. Therefore, all the concepts, the issue of paper start with what the basic thing or the underlying concept for this paper is credit derivative, because this CDS or credit derivative swap are among the most types of credit derivatives. That is why the paper starts with defining what the credit derivative means. Then credit derivatives are designed as a hedging instrument. For example, if an investor who is exposed to credit risk in some reference entity may seek to protect himself by buying protection from a third party. And in effect, the credit derivative market has become trading market. Therefore, the credit derivative always the issue or the concept start if there is less confidence in acquiring these long-term assets or in the forms of liabilities such as assets. Therefore, credit derivative trades have become. For credit derivative trade replication of funded cash. Hello? Can you hear me?
Yes. Yes. Yes, Kadis.
We are hearing you.
Therefore, credit derivative trades have become the replication of a fund cash bond or cash loan of reference entity without all inflexibility, lack of availability, and regulatory and geographical barriers used as the use for intermediary. Then the most common types of credit derivative is credit default swap, abbreviated as CDS. The next thing or the other thing or the objective of the study, this article focus on pricing of CDS contract from an empirical perspective. And the article also had two objectives. The first one is to analyze the relationship between CDS spread and credit spread. Then throughout the paper, both the author tried to analyze, tried to determine, try to define by different measurements the relation between CDS spread and credit spread. Again, the paper also had the objective to examine. The other thing is to examine how changes in credit rating affect CDS and corporate bond pricing. All these things are the main issue that the author tried to see on the paper. On the methods of the study used different analysis methods. For example, the principal component analysis, rational analysis, as well as event study use for different activity in order to investigate the relationship between these CDS as well as credit risk and related with the other things may the researcher used different techniques. For instance, to investigate whether CDS and defaultable bond price credit risk are equal by using CDS spread and credit spread data. Again, regression analysis to study the relationship between CDS spread and credit spread by using Hals and its friends or their friends 2004 approach. Again, on this paper, the researcher used event study to examine how CDS spread and credit spread responds to the reclassification in credit rating. Then they tried to see the relationship between CDS spreads and credit spread related with credit rating. All these things are see or undertake on this paper. On this study, the relation between CDS spreads and credit
Dr. Daniel,
spread.
can you let Maskaram in? Dr. Daniel, sorry.
Excuse me?
Maskaram is awaiting your admission.
Oh, okay, gotcha. Sorry.
Okay. Then on this study, the relation between CDS spread and credit spread fall into two parts. On the first part, investigate whether CDS and defaultable bond price or credit risks are equal or not by applying principal component analysis to CDS spread and credit spread data. Therefore, they tried to whether to check the CDS spread and the defaultable bond price credit risks are equal or not. They apply principal component analysis. Then furthermore, the study take the approach of Hal et al. 2004 and regress CDS spread on credit spread. Again, they use regression method of CDS spread to credit risk, whether there are equal credit risk or not. And after investigating all these things, the findings suggest that CDS spread and credit spread are highly related, but not equal on average. Then based on the regression result, they conclude that actually there is a relationship between CDS spread and credit spread, but not exactly equal. That CDS and defaultable bond price credits risks are different. Again, on the second, they investigate which factor contribute to the price of CDS. In particular, the regression analysis incorporate various proxies for credit risk, such as credit rating, maturity, and amounts of issue of the reference obligation, the default-free short rate, the slope of the default-free yield curve, and industry and timing dummies. Then by using all these as independent variables, they tried to regress. And the finding indicates that credit rating, short rate, slope, and most industry and time dummy are significant information on this CDS. Then they argue from the existing literature and supported in the article, credit rating is an important factor in pricing of credit risk. They conclude based on their analysis, based on different reference source, and finally argue on that credit rating is an important factor in pricing of credit. Therefore, determining, knowing the credit rates of a given bond can help us to determine related with that pricing of credit rate. Therefore, the next interesting thing is investigate how the financial market react to the change in credit rating. Then in effect, they find it's natural to study how CDS spread and credit. Hello?
There's room.
Hello? Hello? Can you hear me? Hello?
We are reading
Hello?
you.
Kadis,
We are reading you, Kidist.
proceed.
Continue, we are reading you.
In effect, they find it's natural to study how CDS spread and credit spread reaction to change in credit rating. And the first part of the article reveals significant difference between CDS market and corporate bond market. Therefore, they conduct an event study using the CDS spread and credit spreads. Are the basic thing made this research differ from the existing study. We are trying to list all those things. For instance, the paper may be special, and it's look at both the CDS market and the bond market.
We
It's
will.
research. Again, it places emphasis on the difference between the two market reaction to change in credit rating. Again, like other study finding, the change in credit rating are anticipated by both markets. Then it's discover evidence of lagging effect on change in credit rating and the difference between investment grading issue. Then all those things may special future for this paper. The finding is that the size of the change in credit rating matter in both the CDS market and corporate bond market. Therefore, credit rating had effects on this credit CDS market and corporate bond market. Then finding asymmetric effect in both markets as downgrading have a large impact on upgrading. They try to see the effects of changing in credit rates, whether that change is downgrading or upgrading, and they try to assess both things, but they conclude that there is asymmetric effect in both markets as downgrades have a large impact than upgrading whenever there is a change in both sides. This supports the literature on corporate bond, but it is the finding of HALS. The result of this paper may somewhat differ from the results of HALS because in numbers of places they use as reference of this paper HALS, and they framed this on 2004. Interestingly, the results suggest that CDS market reaction fast and more significant to change in credit rating than bond market. Therefore, the change of upgrading or downgrading on the credits rates had effects, as I already said, but the change may be fast on the CDS market rather than the market. The paper also see in detail what the credit default swap means. Then we try to define what a credit default swap. Then all these notes are from the paper. In its basic form, a CDS or in a short default swap contract is an over-the-counter between two parties, protection buyer and protection seller. Then the protection buyer wishes to buy insurance from protection seller against the possible default on a bond issue by the third party. If there is fear of loss or risk, the concepts of credit default swap may arise. The bond issuer is called the reference entity. The bond itself is called reference obligation. The reference entity could be a corporate or sovereignty issue. The two parties agree to enter into a contract termination at the time of default by a reference entity or at a maturity, whichever comes first. May the maturity date come first, or may there is a default. In the event of default by referring entity, a CD can be settled with the cash settlement as well as the physical settlement. If there is the existence of default, may two things are undertaken. May there is a cash settlement or a physical settlement. A cash settlement means in which case the buyer keeps the underlying, but it compensated by the seller for the loss incurred by the credit event. It fills the difference. The cash settlement amount is either the difference between the notional and the market value for reference issue or the predetermined fraction of notional amounts. Furthermore, the CDS may include a deliver option similar to the found in treasury notes and bond for contracts, future contracts. If they made on a cash settlement, actually the buyer keep the underlying asset or the underlying bond, and the difference is filled on the cash. The other thing on the physical settlement, in which case the buyer deliver the reference obligation to the seller and in turn receive the full notional amount. Therefore, on the agreement between the buyers and the seller, they also agree on the cash settlement or the physical settlement. In exchange, the protection buyer agreed to pay an annuity premium to the protection seller until the time of default by reference entity or maturity of the contract. Then the maturity of CDS contract is negotiable. Maturity from a few months up to 10 years. However, most CDS are quoted from a benchmark time to maturity of 5 years. Actually, it takes times of 10 years, but most of the time, the paper or most of the time they use 5 years as a benchmark. Then the other thing, relation between CDS spread and credit spread. A combined position of a CDS with defaultable coupon bearing bond issued by the same reference entity should trade close to the price of default-free coupon bearing bond. Assuming that the CDS and the defaultable bond price default risks are equal, based on the assumption that the CDS and the defaultable bond price default risks are equal, then the CDS with a defaultable coupon bearing issued by the same reference entity should be traded close to the price of default-free by considering defaultable coupon bond with its embedded CDS may trade it on the similar or closest price of default-free coupon bearing note. If an investor who invests in a portfolio consisting of a position in a default coupon paying bond and a CD on this bond, eliminate most of risk association with default. In effect, the portfolio itself can be viewed as a synthetic default-free coupon bearing notes. Then, meaning that a defaultable coupon paying bond and there is insurance of CDS may like synthetic default-free coupon bearing notes. The paper said that. Let's gamma bar denote the yield to maturity on a defaultable bond and the CDS spread, the investor's net annual return and then approximately equal to with gamma bar by the C. Then the relation D, gamma bar minus gamma, where gamma is the yield to maturity on a default-free bond. Then meaning that D mean the difference between defaultable bond or the yield to maturity on a defaultable bond minus risk-free yield to maturity of bond. Then, however, on the above equation 1, it's only an approximate relationship as the head is less than perfection. This can be easily by comparing payoff. Consider the payoff consisting of one defaultable coupon bearing with C bar, with fixed coupon, small C bar, recovery rates of high, and payment dates of T1 up to TK. One CDS on this bond with CDS rate of Z and maturity TK. Again with the short position in a default-free coupon bearing bond C with coupon small C bar minus Z and the payment date of T from period 0 up to K. It shows on a table the pay of the portfolio. Then there is a defaultable bond here and CDS also. And there is default-free bond and it shows the portfolio. Then based on this, the outer notice from the above payoff of the portfolio is that payoff of the portfolio is 0 in the case of no default. Again, or however, the payoff of the portfolio is not 0 at a default. In the event of default, the payoff from the position in the default bond and the CDS is a notional value of the default. Therefore, the values of the default-free bond will depend on the dynamics of term structure and default-free interest rate and time left for maturity. Related with the data, they used CDS data have been obtained from JP Morgan case. Again, used 5-year CDS codes, which are the most common traded items, to analyze the relation between CDS and the defaultable bond. Also, they tried to match the CDS data to bond data from Bloomberg Again, match each quoted CDS in the data set to a quoted bond issued by the same reference entity. Again, match the CDS with the corporate bond with the maturity closest to that of the CDS. In constructing the credit spread, they use the treasury curve as a proxy for the risk-free curve. Again, they used 72 firm covered the period from January 2000 through December 2002 as a sample. Then on this sample, they exclude a special future bonds, for instance, embedded option and sinking fund. For each corporate bond observation, collect the standard and Poor's credit rating of the bond, the maturity and the amount of issued. Again, to test whether the approximate relation between the CDS spread and the credit spread hold with equality, consider the following regression. Then they use regression analysis, CDS with alpha beta of spread with assumption of alpha equals to 0 and beta equals to 1. Entity found that CDS and the credit spread do not price default risk equally and not equivalent on average. The author also presents the distribution of CDS spread, credit spread, and average credit rating by industry. And the result, based on that, the result shows that CDS spread of each industry mimic the pattern of the credit spread as expected, but not uniformly. Then CDS spread shows some trends, similar trends with credit spread, but not uniformly. And all these things are expected, but not exactly the same. The other thing is related with credit rating. Credit rating are the most widely observed and common used measurement for credit quality of a special debt issue or the issuing entity. Then Moody and Standard & Poor's are among the largest public rating agency. Bond rates AAA with only capital A and small a by Moons and 3 AAA capital by Standard & Poor's are considered to have almost no risk-free of default in the near future. Therefore, they use as risk-free, whereas credit rating below BBB3 and BBB capitals respectively, that means it's a rating of Moody's and Standard & Poor's are referred to as below investment grade or non-investment grade. Most observation on this paper are or credit rates of A, BB, and BBB, as well as the 2B classes. And finally, the paper results on both the CDS spread and the credit spread shows a clear upward trend across rating classes. There are significant differences and whether fundamental difference exists between the ways that they employed a principal component analysis. The idea of principal component analysis is to reduce the dimensionality of the data description by looking for standard linear combination of the original variables that can be used to summarize the data, losing in the process as little information as possible. And the result clearly suggests that there are differences between the way that corporation bond and CDS price credit risks are. Therefore, all these things are the first part of the paper, and the next thing is presented by Girma. Then thank you.
Okay, Kadis, would you allow me to share my screen? Kadis.
No, why? Shh. Close it. I couldn't end.
Okay. እዛው ቀጥልኝ ወይ እኔ ላውራ። Okay. Can you see my screen?
Yes.
Yes.
Yes, correct.
Yes.
Okay. I would like to thank our professor, Dr. Dennis, and my fellow cadets for our presentation of the front page of the article. And I will proceed and show you or give you some insights about the paper on the back pages of the article. So as you heard from Kadis's presentation, the paper was aimed to see the relationship between the CDS spread and the credit spread, and want to see whether the change in the credit rating of a company has an impact on the pricing, on the CDS spread and the credit spread. So in this part, I will show you the results of regression as well as the event study analysis. So here, the determinants of credit spread and the CDS spread. I will not go over it as it was defined by Kadis already. So here, the point is to find out what are the factors that determine the CDS spread. So based on empirical evidences, the authors propose a linear regression model will fit the data well. So a number of independent variables were selected and tested whether they have an impact on the CDS spread. So here are the model, the linear regression model with a number of independent variables. The dependent variable is the CDS spread, whereas the independent variables is the first one is the credit spread, the second one is the default free short rate, third one is the slope of the default free yield curve, the fourth one is the dummy variable, which is the credit rating of a company. The fifth one is the log of the size of the issue. LI maturity is the log of the maturity period. And the authors added dummy variables, both for industry and the year. So a number of authors previously have done to find which affects the CDS spread. So for example, Longstaff, together with the co-authors in 2004, in its model independent estimate, found that the CDS spread explains on average 49% of the credit spread for AAA- and AA- rated bonds, whereas 51% was explained for A-rated bond, and 56% for BBB rated bond, and 71% for below investment grade bonds. As you can see here, as the investment grade of these issues go down, or from investment grade to non-investment grade, the explanation increases. So on the basis of this fact, what the authors try to do is to see whether the credit spread has a relationship with the CDS spread. And from the empirical evidences that the credit spread are moving in the same way with that of the CDS spread, so that we can see a positive relation between the credit spread and the CDS spread, and the CDS spread do have a positive relation with the credit rating. So they expect, and again, the risk-free short rate, as well as the slope of the default-free yield curve, to have a negative relationship with the CDS spread. And the reason is, as it is explained and discussed by different authors, like, for example, Skinner and Townend in 2002, as the short rate increases, that will make the future value of the debt to decline, which implies that the value of the swap to decline, over which the CDS is calculated, also falls accordingly. And regarding the slope of the yield curve can also be seen as an indicator of an economic activity. So the steeper the term structure of the interest rate is associated with an improvement in the business climate, whereas a flat term structure is economic activity. So that the slope, which is the default free slope yield curve, expect to have a negative relationship with the CDS spread. As we know that CDS spread, as well as the credit spreads, are the prices for the credit risk. So as the economy is improves, the probability that the company will make a default comes down. As a result, the seller of a protection will charge the buyer of the protection lesser amount. That's why the short rate and the slope of the yield curve have a negative relationship with the CDS spread. And here is the first regression output by taking the CDS spread as a dependent variable, and the credit spread is taken as an independent variable, along with the dummy variable, the credit rating, the short rate, the slope, and the industry and time dummies are included. The authors ran 3 different regression. First for the full sample, and the second by looking the investment grade and non-investment grade issues. So the dummy variable credit rating is coded to 1 for the credit rating that ranges from AA to BBB, whereas 0 otherwise, or for below BBB are coded for non-investment grades. So as you can see, the values of the regression coefficient for these 3 independent regression output, the credit spread comes with a positive coefficient, which was expected, and the dummy variable credit rating as well positive, because when the company's credit rating steps down from A to A minus, B and C, then the protection sellers charges a higher amount. So that this dummy variable is positive in all of the 3 independent regression. But if you see the value for non-investment grade, it is higher. It is higher, indicating that the credit rating of a company has a significant impact on the CDS spread. Again, for the short rates, as well as the slope of the yield curve, the coefficient of the estimation is negative. It comes as it was expected. And the values are increasing as you go to the non-investment grade, about 72 and 53 for the short and the slope coefficients. This indicates that for non-investment grades, the coefficients come up with the larger negative, meaning that non-investment grade issues are significantly affected by macroeconomic events. And the other regression output here for industry gains. So except for few, like for example, the capital goods in case of full sample, and the defense and the leisure in case of the non-investment grade issues, in all of the cases, they are found significant, indicating that these industries or the industry to which this reference entity belongs matters. So that it is an indication that the CDS spread should be different for different market segmentation, Again, the time dummy is significant for the 2000 and 2001, except again here, as you have from rating has a significant impact on the pricing of the empirical findings that have evidenced the credit rating has an impact on the price of low investment grades. So what the authors did is to estimate the regression model given equation 3, replacing the variable that is the dummy rating, credit rating, with a set of dummy variables. So on the basis of this, they categorize the dummy variables into two, and they code one for credit rating that ranges from AA to single B, and coded 0 otherwise. So the following table figure I will show you, that's exhibit 7, shows the regression coefficient and the standard deviation. And we'll see what the effect of the credit rating. So as it is depicted in the exhibit 7, the regression coefficient for credit rating dummies, as you see, as the credit rating of this company deteriorates or downgraded from A to B, the coefficient is increasing. That means the CDS spread or the estimation coefficient increases. For example, in the AA rated company, the estimation coefficient is -50, but at the rating of this company deteriorates or downgraded to A, the estimation coefficient becomes increasing and reaches 0. And the line is become steeper when the rating for this company drops from BB to single B, so that it's possible to expect for the CCC companies, the line becomes too steep. And this will present you the credit spread, the CDS spread, and the change in the credit rating. Now, at this point, what the authors want to examine is how the corporate market, the corporate bond market, and the CDS contracts differ, or how they are responding to change in the credit rating. So therefore, it's natural to examine whether the CDS contract and the corporate markets do have the same kind of response to the change in the credit rating. So what the authors did is, in this section, they examine whether a change in the credit rating of a particular bond is immediately reflected in the price. So they include the CDS contract in the study for comparison purpose by taking data from 41 firms of a total of 59 downgrade and 11 upgrades. As we know, or as the theory suggests, that a downgrade or an upgrade in the credit rating of a company could cause the spread to jump up or down. So for the purpose of illustration, the authors take one company, that's the Motorola Corporation, to show how the effect of changing the credit rating affected the price, both in the bond and the CDS contract. So this Motorola Corporation has experienced a 3 downgrades. It was originally rated A, then within 2 years, it was downgraded to A-, B, triple B+, and finally to triple B. So as you observe from this picture, the drop lines indicate the time where the downgrade has occurred, and the dark line shows the credit spread, whereas the trombone, or maybe you can take it, the yellow line, is indicating the CDS spread. So the first downgrade occurred on June 1, 2001. At this point, this is dropped line, the first downgrade. But as you can see, the movement in the credit spread and the CDS spread, you can see no clear effect. But a few days after, the CDS, the trombone canal here, stepped up about 15 basis points. And there is no change on the credit spread. But on the second downgrade, which has occurred on October 31, 2001, we see an upward in the credit spread, of approximately 40 basis points some days before, but no clear changes in the CDS spread. But the last downgrade, which has occurred on July 1, 2002, we see a clear upward trend, both in the CDS spread and the credit spread, even before and after the downgrade. So from this, we can see what the reason may be. So one reason that changes in the credit rating has little effect on the spread. And that is often the market anticipates the reclassification and has therefore already made a correction in the prices. So to examine these, they go empirically. So whether a change in the credit rating has an immediate effect on the credit spread and the CDS spread. And they apply an event study analysis. So in particular, they employ a constant mean model, essentially testing whether the level of the spread changes around the time of the change, or maybe before and after that. So the model allows them to examine whether a structural break in the spread occurs around the time of the change in the credit rating. So the model setup begins by defining what an event is. So in this case, the event is to indicate the change in the credit rating. And the event date is to indicate the day that the credit rating has occurred, the change in the credit rating has occurred. So that the period over which they measure the effect of the event on the CDS spread and the credit spread is referred to as the event window, which is indicated by a letter. And to measure the behavior of the CDS spread and the credit spread prior to the change in the credit rating, they use a sample of observation, which prior to the event window are the reference sample. So that the reference to this set of observation as it is indicated as a summation window and indicated by L1. And they collect the summation window sample, such as the summation window, is the same for each event, regardless of the choice of the event window. So they do this to compare results for each choice of event window. So the event window can be 3 days, for 15 days, 10, and the like. So based on that, they want to compare whether there is a difference in the result between these event windows. So the author's construction is to ensure that every event window spans only one event, and all observations in each estimation window are from the same rating classes. So they submit the following equation over the summation window. So S to the exponent of M to the subscript IT indicators the vector of the spread, which are independently and multivariately distributed. And the mu to the exponent M indicators the vector of the mean of the spread to taken over L1, which is the event window. So, and it's constant for all T and M, and this works for the CDS as well as the credit spread. And they can estimate the excess spread. And the excess spread is given by the difference between the vector of the spread minus the vector, the summation window. And they define the cumulative results, which is represented by the mean Z to the exponent M, or the summation of the residuals with sample variance, and it is given as the covariance matrix of the excess spread. So by assumption, we know from the econometrics that the error terms are not correlated with the independent variables, so that the error term, which is the sum of the excess spreads, are not correlated with across the firms and across time, implying that we can aggregate the cumulative excess spread over a subsample gamma of n events. So from this, the gamma could be an upward change in the credit rating, all changes for one reference entity or similar. So initially, the null hypothesis is that the change in the credit rating has no effect on the excess spread, which is given by Ju as a ratio of the sum of the residuals divided by the sample variance. and which is asymptotically standard, normally distributed under the null hypothesis. For your information purpose, the study uses estimation window of 75 observation, ending 31 business days before the event. And they do this in order to ensure that the estimation window is the same for all studies, with this specification of estimation window and event window. But they find only 41 downgrades and 8 upgrades. So exhibit 9 depicts the cumulative excess spread that was observed between 30 days before the event day and 15 days after the event day. So minus 30 here indicates 30 days before the event day. 0 is to indicate the event day, whereas 50 is after the event day. So here the lines, the connected lines flowing above the time span is to indicate the downgrade for bond and the CDS contract. The darker line is for bond downgrade, and the black line is for the CDS downgrade. But the dotted lines below CDS contract. As you can see here, the result of the cumulative excess spread is negative for an upgrade and positive for the downgrades. But if you take the absolute value, it is larger for an upgrade when it is compared with the downgrade. But at this point, what this exhibit depicts to you is whether the behaviors with respect to time and the contract between the bond market and the CDS, the behavior across time is different for these two contracts. In the above line, as you can see, the downgrade for the CDS contracts are moving or fluctuates over time and reaches peak just before and after the event date, where you can see a little bit a constant or a smooth movement for the bond market. So from this, we can say that there is difference in the behavior between the contract and across between the bond market and the CDS contract. And the authors as well try to see the effect of the difference in the credit rating by taking different event windows. So the first minus 13 to minus 16 indicates the 30 days and 60 days before the event day, whereas minus 15 to minus 1 is indicating 15 days up to the immediate day before the event day.
Hello?
And the third one ranges from,
No, go ahead.
May I proceed?
Yes, please. Yeah.
Okay, the third one indicates a 3 days event window that ranges from a day before the event day and 1 day after, immediately after the event day. And the last one is from 1 day after the event up to 15 days after the event day. So the authors want to see the effect on the credit spread as well as the CDS spread, both for downgrade and upgrades. As you can see, the results of the estimation for A-rated and B-rated is different event window. They found again for the CDS spread all are significant, and the value of this estimated coefficient is larger for A-rated company and for non-investment grades. And as you can see, the values or the test statistics is significant around the event day, And for the upgrades, since it's only 8 companies or 8 observations were taken, and they are not as such significant, except for the CDS spread. And if you see how this have an effect on the credit spread and the CDS spread for company, for A-rated company, B-rated company, the values are larger in case of CDS spread than the credit spread. So the test statistics also indicated that this pattern is particularly visible around the event rate. This suggests that the CDS market are more liquid than the corporate bond market. In the sense that in the CDS spread and the CDS than the, is to see the determinants of changes in the credit spread and the CDS spread using different event window. So here, what we are going to see is the regression output for the different event windows. So the table presents a regression analysis of the determinants of changes in the credit spread and the CDS spread. So the dependent variable in this case is the absolute value of the cumulative excess credit spread and the cumulative excess CDS spread respectively. And in particular, the variable, the independent variables, the dummy variable, which is the credit rating, are categorized in this way. And the shift size, which is another important variable in this case, is measured for the number of rating classes by which the reference entity is upgraded or downgraded at the event day. And we take this as, because for downgrade and an upgrade, negative for that. So the variable takes the value of 1 if the firm is downgraded or upgraded by 1 rating class at the event day, otherwise 0. And the explanatory regression variable, AA, is a dummy variable which takes the value of 1 if the firm was originally rated AA before the downgrade or upgrade, otherwise 0. So in the same way, the rates are defined. Further, they include the dummy variable upgrade in the regression analysis, so that the variable takes the value of 1 if the event is an upgrade, otherwise 0. And the total observation includes 75, ending 30 days business prior to the event day. So this is a regression output for the first event window that was taken 30 to 60 days before the event day. And they ran 3 different regression model. And here the dependent variables, as it was indicated, the cumulative credit spreads for the credit spread as well as the CDS spread. But at this point, I want to show you only 2 variables. For the first model, in case of the credit spread, the upgrade is negative but insignificant. But the shift size is positive and change in the credit rating by 2 or more classes would have an effect on the credit spread. In spread, the upgrade is found significant, it's positive and significant. So for the CDS spread, an upgrade is significant, and it explains. The next is for the second event window, which is 15 to 1 day before the event. Authors ran 2 regression models for both credits. So again, in the CDS spread, as you can see, the upgrade is negative. And in the CDS spread, you can see it is negative but significant, but are significant. In most cases are significant. In the third window, which is taken for only 3 days, including the event day, the credit spread and the CDS spread are observed here. The upgrade, again here, not significant, but only for the CDS spread. It is, again, in this case, for both the CDS spread and the credit spread, an upgrade variable is not significant. Means an upgrade of one credit class have no effect on the CDS and the credit spread, it means. And the last regression output is for first up to 15 days after the event day. As you can see here, the upgrade again found insignificant in case of credit spread, but it is significant for CDS spread. So in all of these regression outputs, as you can see, the upgrade in credit rating by one class spread than the credit spread. So overall, the finding suggests that a rating reclassification affects the lower credit rating classes more than the highest in both the CDS contract and the bond market. And the regression coefficient for the variable shift size are positive and highly significant for all studies. And here is the conclusion for the paper by my classmates to read from the PPT. I will attach it for you.
Dr. Dennis?
Yes. Okay, thank you. That was very good. So I have a question for the team. Because you kind of just focused on the empirical. What is the difference of monitoring of the two markets? Or first, can you explain what is a monitor and which one of these monitors is better in terms of monitoring of the risk?
On which one? The credit or the CDS spread?
Yes.
From the two.
The two, which one is better and why?
To monitor the market.
Yeah, which one is better and why?
Yeah, actually, in the CDS spread, where there is regulation, it can be helpful in controlling the risk of losing the whole investment maybe. But since in this credit derivative, its operation may not be under the guidance of a regulator or an oversight company. So the risk is that some traders may use the CDS or the credit derivative market for speculative purpose. So when there is no regulation, it can expose investors for moral hazard. So, but when there is a regulation in place, the CDS works more because any individual who has a surplus for the time being can let anyone to use the money so that he can generate the return over it. But because of the fear that there may be moral hazard or they may lose their money all at a time, they may not lend their money for investors, government, and the like. So that maybe, for example, in case of Ethiopia, where there is no rating agencies, and where the bankers, where the private companies are not allowed to issue bonds and make it available in the market for the investors, maybe the CDS market or the CDS contract is very risky is very risky because it cannot be controlled and managed under the conventional rules that works for the insurance company.
Okay, all right.
Shall I go to you, Doctor?
Dr. Dennis,
Yes, go ahead, yes.
Kadist is asking apology because she lost power, electric power.
Okay, all right. Okay, we have to conserve time, so that was very good. Who's up next?
We.
Okay, shall we continue?
Yeah, continue, yep.
Abdullah,
Yeah.
why don't you? Let's
Okay.
continue.
So allow me to share.
We'll let Ms. Mescaron, we always defer to the young lady, so Ms. Mescaron and Abdullah, go right ahead. Mr. Abdullah, you gotta learn to speak up louder. Say yes.
Yeah, here it is now. First, give for Maskaram. Maskaram is presenter at the first part.
Okay.
Yes.
Okay, thank you. First of all, I would like to thank Professor Daniels for giving us this chance for our group, and I will continue to present our part. So as you can see, the title is Facts, and this is the title of the article, and two authors were writing the article, and it was, so these are the names of the authors. You can see, I don't have to read it, I think. So it was written in 2004, and we are the presenters. We all three present the articles, so we have our part. So as an outline, we have this outline. So we'll share each of the topics and we'll present all of the three. So let's go to the introduction part. So the commodity futures, they are relatively unknown asset class. But the thing is, the commodity future, it has, even in US, it has 100 years since it has started. And these researchers, they even explained that the commodity futures, it has dated back to 4,500 up to 4,000 BC. It has origin in Mesopotamia. So as you can see, it is an older one, but as it is old, there is no well-known attention. So it's why is the reason? Because commodity futures are different from stocks and bonds and other conventional assets. The main differences are listed here, as you can see. And the first difference is commodity futures are derivative securities. That means their value is derived from the underlying assets. And the second difference is their short maturity claims on real assets. So the period involved as compared to the stocks and the bonds, it is a short-term one. And unlike financial assets, many commodities have seasonality in price levels and volatilities. So it means at the time of, for example, if you take agricultural commodities, at the time of harvest, price will be low, and the other time price will be high. So price will be highly volatile. The fourth difference is they don't raise resources for the firms to invest because their objective is hedging. That means they give protection for the forward sellers. So another reason is commodity futures are relatively unknown due to scarcity or lack of data. So there is no data availability as compared to the conventional assets. By the way, this is what the authors are arguing. And commodity futures price represents bets. Bets means agreements on the expected future spot price. Another is investors in commodity futures receive compensation for bearing the risk of short-term commodity price fluctuation. So that compensation is the risk premium, which I will discuss in the coming slides. So in light of this background, the researchers they have tried to answer, as you can see, these many questions. So they have raised many questions, as we see here. But many of these questions, especially the first 5 questions, they were also addressed by many researchers, including the famous researcher that Fama and French and others also. They have tried to investigate these issues, but the difference is those researchers have used short data, and the authors are arguing they are using large data. That means they have included 45 years commodity data in their research. So that is the only difference as compared to the previous researchers. And the next is the next slide. So let's see the mechanics of an investment in commodity futures. So how is it operating? So the first is let's define what commodity future contract is. So it's simply an agreement. It is simply an agreement between 2 parties. So we have a buyer on one side and the seller on the other side. So they will agree on a specified amount of quantity as well as price, as well as a certain delivery date. So that price which they have agreed upon, we call it as future price. Actually, the future price is different from the value of the future contract. What is the difference between the two? If we take a future price, it is a fixed one. So at the start of the contractual agreement, the future price will be fixed, whereas the value of the future contract starts at 0 from inception, and then it will change throughout the life cycle of the contract. That means until the delivery time. So this future price determines the profit to the buyer, whereas the value of the future contract will determine the profit to the seller. That's why the future price and the value of the future contract is different. So as I said, upon entering into a future contract, no cash changes hands means there is no cash payment as well as cash receipt between the buyer and the seller. That's why the value of the contract will be 0 at the time of start. Another point is how is the future price determined? How that future price, which is to be exercised on the delivery date, will be this price. Normally it has to be a fair one. How will you determine this? It will be determined by the participant. That means market participant includes buyer firms are also part of it. So based on this interaction among this market participant, the future price will be determined. So this tells us the future market is a forward-looking market. because the future price includes expectation also, future expectation, as well as the future spot price is also included while determining the future price. So here there is a spot price. So what does it mean by spot price? So the spot price is the current quote, the current quoted price for immediate purchase, for immediate payment, or the delivery of a particular product. So it is different from the future price. So if you consider future price, it's an offer that will occur on the later date. So that is the difference between the two. So sometimes the spot price might be higher, sometimes it will be lower. So if spot prices are expected to be much higher when as of the maturity, so the future contract done there today, the current future price will be set at high level relative to the current spot price. So this is how it is moving. So a lower expected spot price in the future will be also reflected as a lower current future prices. So this is as per black. Another is futures investors. So we have future investors, so we have future sellers also. So future investors will benefit when the spot price at maturity is becoming higher than the expected. So when they entered into the contract, they may also lose when this spot price is lower than what is anticipated in the future. So from the commodity future, what return can an investor in future transaction expect to earn if he or she does not benefit from the expected spot price movement and is unable to outsmart the market? So sometimes you may not outsmart the market. So in that case, so what is the benefit then? In that case, the future investor will get a risk premium. So what is this risk premium? It is the difference between the current future price and the expected future spot price, which means the price that we expect as of the delivery date. So the difference between the two will be the risk premium for the future investor. So two situations will happen now. One is if today's future price, which is the fixed price, is less than the expected future spot price. In that case, the purchaser of the future will earn money, so it will make a profit. The second is if the future price, that means if the fixed price at the time of the contractual agreement is greater than the expected future spot price. In that case, the seller of the future will earn a risk premium. So these are the two things which might happen in the future. So there is one question that the authors or the researchers wanted to answer. So they raised two questions, sorry. So one is how is the risk premium earned? Another is, do speculators have to hold the future contract until expiration? So they have asked this question and they got an answer. The answer is no. Why? The reason is, over time, as the maturity date of the future contract is becoming closer, the future price will start to approach the spot price of the commodity. So this is what is expected to happen. Another is, at maturity, the future contract will become equivalent to a spot contract, and the future price will equal to the spot price. So if future prices were initially set below the expected future spot price, because the future price is forward looking, so we may not set an exact price. So sometimes it might be below, sometimes it might be above. So if future prices were initially set below the expected future spot price, the future price will gradually increase over time, rewarding the future seller the long position. Let's see the next one, construction of commodity futures portfolio. So in this, the researchers, they have constructed a portfolio. That means a group of investment considering commodity future one side and stocks and bonds also as a comparison. So the researchers constructed a monthly time series of an annually weighted index of commodity futures starting in 1959 and up to 2004. And they have included 45 years data in their analysis. And they focused on an index because they wanted to address the above questions with respect to the asset class as a whole, rather than with respect to individual commodity features. So as I told you, there are portfolios, combination of bonds, stocks, as well as the commodity feature. So in order to draw a meaningful comparison between the performance of futures and other asset classes, the researchers controlled for leverage when calculating future returns. So this is what they did while doing their comparison. The other is they made assumptions that future options will be fully collateralized. That means when an investor buys a contract with a certain future price amount, for example, in this case, $25, they will also. So researchers are assuming that investor will simultaneously invest in the same amount in treasury bills. So this is how they collateralized the future contract by buying a treasury bill with equal birr or dollar amount. I will continue. So,
Ms. Mescalero, you need to keep it cut. You need to watch out for your time. You have two other members, and I maybe have 1 hour for your presentation. I just want to make you aware of that.
Okay. So the source of data that they have used. Okay, Professor Daniel, I will. The source of data they used is, so they maintained a database from Commodity Research Bureau, and the data that they have included is from 1959 up to 2004. So 45 years data were included in the study. So the next is historical return of commodities to spot and features. So here also they have raised, they did an empirical evidence, and they tried to answer these two questions. What is the average return to the commodity features? And another question is, does the collateralized futures position outperform the spot return for average commodity feature? So from this, they make conclusion. The conclusion is the historical return to an investment in a commodity future has far exceeded the return to a holder of spot commodities. And the other conclusion they reached is the equal weighted indices of both commodity spot and commodity futures prices have outpaced inflation. So that means it improves the inflation situation. So let me skip. So here, let me skip this slide. So the next slide, Abdullah. Yeah, let's see this one. Let's see this one. That's no, the table. So let's see the table. So the table one. So when we look at the table, so earlier I have told you there was portfolio of investment. So they are comparing the investment in commodity futures, stocks and bonds. So the average risk premium, as you can see, the stocks, so the stocks is a Standard and Poor's 500 stock was considered, and the bond is also considered. So average risk premium, so commodity future is also considered. So as you can see, the risk premium of stock is greater than the commodity future. So the higher the risk, the higher will be the return. That is what we see here. And if you see also the Sharpe ratio, however, when you see the Sharpe ratio, the commodities future Sharpe ratio is higher than the stocks as well as the bonds. So this might be an indicator that investing better than the other. So the next slide. So this also, let's look at the other table. So here also we have average return from the commodity futures and the stocks and bonds. So the researchers are comparing this, and also the standard deviation. So as you can see, the higher the risk, the higher the return. So stock investment is riskier than commodity future investment. And the bond investment is less riskier from all. That is what the standard deviation result and the average return result indicates. So the other slide. So I'm making it fast so that you will have time. So so from this, from the table 2, we have three conclusions more or less. So commodity futures and stocks have the same average return, but standard deviation of the stock return is slightly higher. So more or less they are comparable. The second is the return distribution of equities have negative skewness. So the table shows it is negatively skewed. That means it is skewed to the left, while distribution of commodity return, it has positive skewness, so it is skewed to the right. So there is also a difference in that. Next slide. So let me stop here my presentation. From this on, Muluna will continue. So I'm rushing because of time. Thank you.
Muluna? Hello, Muluna.
Can you hear me?
Yeah.
Yeah. Okay, thank you all. Thank you, Maskaram. And I will continue from where Maskaram stopped. And this part is, to see the correlation of commodity futures with other asset classes. By other asset classes included here are, stock indexes and bonds, among others. In this part, authors examined the correlation of commodity futures with that of the stock, bonds, and inflation. Inflation is taken as one parameter against which the commodity future performances are compared with. And this correlation is made over different time span, starting from a short period, which is monthly, up to a longer period, which is 5 years. You know, the result of the correlation shows that the equally weighted commodity future total returns are negatively correlated with the return on the stocks and long-term bonds. I mean, the relationship between the bonds and the stocks is negative. While you know, it is not possible to reject the hypothesis that the correlation of commodity futures with the stocks is zero at short period of spans, as the correlation result shows that some of the results are not statistically significant. The findings suggest that the commodity futures are effective in diversifying. The fact that the relationship between the commodity and bonds and that of commodity futures is negative. Negative mean as one is increasing, the other is decreasing. And this is, you know, a fertile ground for diversification. That's one finding of the authors. And the other is in relation to the negative correlation of commodity futures with stocks and bonds tends to increase with the holding period. We said the relationship is negative, but this negative relationship in strength is found out to be increasing with time span. I mean, the negative correlation is stronger over a long period of time than besides found out to be positively correlated is larger at a longer horizons. The commodity future performance or return is positive, but still this relationship is stronger again over a long period of time. And what we see on the next slide is, you know, a tabular presentation of this result, Abdullah. As you can see here, the relationship of commodity futures with that of stocks, bonds, and inflation is, you know, evidenced over different time spans, monthly, quarterly, 1 year, and 5 year. As you can see, the commodity futures is negatively correlated with that of stocks and bonds in almost all of the periods, negative correlation. And this correlation of commodity future returns with that of inflation is positive, as you see. This can entail that, you know, we can do a better diversification by using the return of the investment on commodity futures and investment on stocks and bonds. I mean, if we create a portfolio combined of stocks, bonds, and that of commodity futures, we could be able to get a better diversification. And you know, as a continuity to this, the authors went to check whether the negative correlation between equities and commodity future returns are low. Returns are low that year. One may have an investment on equity, and that investment on equity may provide, you know, a downside return or smaller return. And normally requires just want to check that, and commodity futures its returns are normally very less. And results are this one. They took, you know, two categories of smaller returns of equity. One, they took 5%, and the other, I mean, of all 5 months and the lowest 1% of the monthly performance. During the 5% of the month's worst performance of equity markets, when stocks fell on average by, about 9% per month, commodity futures experienced a positive return of 1%, which is slightly above the full sample average return of, again, 0.89. This exactly depicts that at the time where the equity markets are performing bad, then the commodity futures are performing good, especially over this, the lowest 5% low performing equities. And regarding the 1%, during the 1% of months, the 1% of months of loss by 13% per month, commodity futures performed on average in a positive of 2.36. This is also a similar result with that of the 5%, but the lowest 1% average performance of commodity futures is better than the lowest 5% of equity returns. They just also wanted to check, the other side of the coin, whether the lowest performing commodity futures are negatively related to that of the equity returns. So for symmetry, the authors also examined the situation in which commodity markets have their poorest performance. The average return 2%, in fact, months in terms of commodity market performance was negative 1% and negative 4%. So the other side of the story doesn't hold true, like it was the case with that of equity. In case of equity, at the time of low performing equities, commodity futures were performing good. But at the time of low performing commodities, there is no better. So the conclusive remark out of this finding is that it seems the diversification benefits of commodity futures work well when they are needed most. When they are needed most mean when they are needed, and that is when the equity returns are very small. And they went further and wanted to check, the relationship between commodity future returns themselves and that of the inflation. How commodity futures react to inflationary change. From the outset, they made a theoretical assessment that bonds and stocks are basically affected only by an expected portion of inflation. They tend to classify inflation into two, Some inflation is the expected inflation, and some of the inflation is a surprise, unexpected inflation. Even to the extent of unexpected inflation, bonds are less affected by that of the inflation, because one, bonds are nominally denominated, and the nominal rate of bonds normally includes the stocks. Stocks are also less affected, stocks are claims on the real estate of the inflationary effect themselves. So having this theoretical claim, they wanted to check how commodity futures are, related to inflation. And the findings are commodity futures have an opposite exposure to inflation compared to stocks and bonds. An opposite exposure means the way stocks and bonds react to inflation and the way commodity futures react to inflation is different. Stocks and bonds are negatively correlated with inflation, while correlation of commodity futures with inflation is at all horizons positive. And this, positive correlation of commodity future with inflation is statistically significant, especially at longer periods of time. That's one. And in absolute magnitude, inflation correlations tend to remain when the 5 years, the correlation strength in absolute terms, in fact, tends to increase. The negative inflation correlation of stocks and bonds and the positive inflation correlation of commodity futures are larger at return intervals of 1 and 5 than at the monthly and quarterly level, which means the strength increases along with the time span. This is what you see here. There is a negative correlation between inflation and stocks. There is a negative correlation between bond and stocks. There is a positive correlation between commodity futures and stocks. And at the time period taken increases, the inflation magnitude increases. By the way, that's statistically significant. Okay, Abdullah. Authors also examined the correlation of stocks, bonds, and commodity future returns with components of inflation. I mean, I two. One is expected inflation. The other is the unexpected inflation. Abdullah, can you show the next slide? Looking on the table may be good.
Yeah, this one?
Yeah, as you can see here, there are stocks, bonds, and commodity futures, and so the components by the authors in terms of how the nominal rates changed in the rates of the stocks, the bonds, and the commodity futures
Hello,
do you hear me?
Okay.
I can hear you now. Do you hear me?
Yes, yes.
Okay, sorry. Okay, let's get back to one slide behind. To the text.
Next.
Back. Yeah. Back, yeah. I think one more. One forward. Okay. Okay, let me proceed from here. We have said that, we have said that commodity future returns are negatively related with stock returns. We determined this, commodity future returns by themselves are negatively related with that of the stock returns and bond returns, in fact. And more, commodity futures have an opposite exposure to unexpected inflation from that of stocks and bonds. By the way, the earlier table shows that the exposure of commodity futures to that of inflation is opposite to the exposure of stocks and bonds to that of inflation, particularly unexpected inflation. By the way, the authors determined that of inflation, it is the unexpected inflation that is highly impacting the returns of the stocks, the bonds, and the commodity futures. So the authors concentrated on the unexpected inflation part. So the result is commodity futures are negatively correlated with stock returns, and commodity futures has an opposite exposure expected inflation account to the negative correlation between future. I mean, it's resulted in negative future the stock is a very question. Shortly, those